Hello and welcome to the TheoTrade report for Tuesday, October 25th. My name is Doc Severson. Okay, after hours today we had one of the big tech bellwethers, Apple, reporting. And right now as we look at the monthly, the weekly, and the daily, all we see is uptrends at every time frame so far. But there's a little bit of trouble in paradise because of their most recent earnings. So looking at an intraday chart of Apple, we can see that it was pretty much oscillating right around the $118 level, and that was right before they reported. They shot up initially up to about almost $122 a share, pretty big move, and a lot of that was based on the bottom line, which actually beat the projections by a couple of cents. But then they started to read further down the report, and the revenues were light. And apparently the forward projections are somewhat dismal right now for Apple. So even though one of their biggest competitors is off the market with the Note 7, this is still not a good report, not a good reaction to what should be a very strong report. Well, with this in mind, what's the rest of the week going to look like? Well, we have a couple of big ones here with Amazon and Google set to report later on this week. So here's Amazon, and Amazon has actually been knocking it out of the park in terms of its most recent earnings, right? So the last time it had a bad one was back here in January, but since that point, it's been knocking it out of the park with every subsequent release. So this one comes, I believe, Thursday. If we look over here, we have 10/27, which is Thursday aftermarket Central Time. And then we have our friend Google. Okay, so Google is going to be coming aftermarket Central Time as well. So Thursday afternoon, it was going to be huge. So both of these stocks have done really, really well lately. Although I would have to say that of the two, Google is coming out of a much stronger base. Google is coming out of a much stronger base, so there's less of a chance of Google imploding. But we have to be very, very careful with Amazon because stocks like Amazon and Nvidia have just absolutely gone vertical. And this is where we have to run into when we have a stock with almost an infinite slope to the upside. Typically, we're going to have a really tough time on the backside of this when the disappointment hits. So whether it's a disappointment, whether it's going to be some indirect factor which Nvidia has no control over whatsoever, something will hit this thing on the backside and cause a tremendous amount of damage. It can still hold a primary uptrend. I mean, think about this for a second. If Nvidia went from 72 all the way back down to 40, it would still be holding a primary uptrend with a higher low here. And what we have to watch out for is a lower high setting up after that. So when we look at all this evidence of all these NASDAQ stocks just going absolutely ballistic to the upside, what I'm doing is I'm going to take the opposite side of that. I'm going to take the opposite side of that. So I've got a NASDAQ chart. In this case, the Qs are actually coming up to all-time highs again, back from 2000 at about 120.5 or so. And when you throw that into the mix with a little bit of volatility that I would expect over the next 30 days, I'm expecting at least some movement around here. Now, listen carefully to this. I'm not necessarily projecting any downside movement for the Qs, right? So I'm not necessarily forecasting a big bear market or a big downdraft or a big sell-off. All I'm anticipating is seeing volatility show up in the Qs, especially, right? So even if we get some movement around in this area over the next 30 days, what can we do to design a trade that's going to be able to benefit from something like that? Okay, so the place that I could start, because again, coming up with a forecast for this, half of you are going to be right, half of you are going to be wrong over the next 30 days. I don't know what's going to happen in the future. All I know is that I'm expecting volatility. And if we cut that element out of it, then it simplifies our task dramatically. Let's go over to the option chain here. So let's go over to the Qs and the option chain. And I want to look out at something that's maybe about 30 days out. And so we have plenty of liquidity here, so I don't have to worry about that with the Qs. Let's go over to something where we can get a better read on the chart here. And you can see that what I've got is a position called an in-out spread. We've got one option in the money. We've got one option out of the money. This is a simple debit vertical spread. Now, the last thing to look at here is that the expected move over here in the upper right-hand corner, plus minus 4.2 points. So there's a 68% chance that the price will end up after 31 calendar days somewhere within this plus minus 4.2 point range. So we can go over here to the analyzer and look up at the position here, and we can see it's a simple put vertical where obviously we want the price to go down at some point during its life, and if it goes up for it, we have defined risk for the trade. But we can simply, again, remember the plus minus 4 point range. If we start out here with about 119, going down 4 points, going up 4 points, really. So we've got kind of a range for this, a profitability for this, which is around right there, So here is the way that we define risk on the trade. So the risk is if the price continues going higher from here and it stays up there. How likely is that over the next 30 days for the price to just continue going higher, higher, into all-time new highs without any kind of a pause, without any kind of a pullback? I would say, considering the risks on the table over the next 30 days, very unlikely. How likely is it then, therefore, for the price to maybe wander down and maybe scare everybody down here into this area over the next 30 days? I'd say fairly likely. Now, again, with this trade, we don't have to sit there until expiration. Many people look at the expiration graph, which is the green line here, and say, well, that's the trade right there. No, it's not. This is actually the trade. This is what's going to be moving through time. And this is what we're going to be managing around. So bottom line, what I'm expecting over the next 30 days is maybe we're going to react to some of these earnings this week. Maybe Amazon and Google do well and the price pops up. But just as easily, something else, perhaps like an Apple, right, is going to pull things down. And we're going to just work within this range, I think, within the next 30 days. All I need is some kind of movement to the downside at some point before expiration, and I'll be able to take this trade off for my fair share. So I think this is a great example of where we're not necessarily trading based on direction. All of us get locked in on direction, that we have to be right about direction, and that's certainly the case if you're buying long calls or buying long put options. But with a trade like this, if you understand how price moves and if you understand kind of the limits around the trade, designing the trade logic to factor in the normal movement of price that I expect over the next 31 days will allow me a very high percentage of profit on a trade like this. Okay, folks, that is it for today's report. Hope that helps. Thanks for listening, and we'll see you in tomorrow evening's report. Take care.